Most people blindly accept that they need to pay X% tax for this, X% tax for that. But what if I told you there are at least 25 ways to legally pay less of it without breaking a sweat or, the law? In this video, I'll teach you 25 proven strategies from my 20-odd years as a qualified accountant. Some are specific to limited companies and some are applicable to nearly everyone. So grab a cuppa and a chocolate hobnob. Other biscuits are available and let's get into it. So let's start with one of the most powerful and most ignored weapons in the tax-saving arsenal: pensions. I get it. Pensions don't feel urgent. They don't scream fun or flexible, but tax-wise, they're a thing of incredible beauty. But let's look at the impact. Firstly, for limited companies. Your company can contribute up to £60,000 a year directly into your pension pot. And here's why that's brilliant. It's not treated as personal income. No national insurance. It reduces your corporation tax bill because it's a deductible business expense. Plus, you can wait until you're almost at your year end when you know what your likely profit is. Example time. Let's say your company made $80,000 in profit. You put $10,000 straight into your pension from the company. Your new taxable profit is $70,000. If you're paying the 25% corporation tax rate, well, that's an instant saving of approximately $2,500. Plus, that tax-free $10,000 is now growing inside your pension like a well-fed gremlin after midnight. Even if you're on the 19% rate, you still save around £1,900. And again, no NI, no income tax. Brilliant. But what if you're in a sole trader or partnership business? You can still get tax relief on pensions, just in a slightly different way. Your contributions come from your personal bank account, and HMRC tops up your pot automatically with 20% basic rate relief. But if you're a higher taxpayer, 40% or more, you can go back for seconds via self-assessment and claim another 20%, 25%. For example, you pay in $8,000 from your own account, HMRC adds $2,000. Your pension now has £10,000 added to it. Then, if you're a higher rate taxpayer, you can claim back another $2,000 on your tax return. So your $10,000 pension boost only cost you $6,000 out of pocket. That's a 40% tax win, and it's completely above board. Let's talk about another widely underrated tax win, especially if you're working from home even part of the time. And no, this isn't just for freelancers surrounded by cold coffee cups and half unplugged chargers. This works whether you're a sole trader or running a limited company. If you do any work from home, whether it's in a dedicated office, at the kitchen table, or from under a duvet, your business can reimburse you for part of your household bills. No, you don't need to rent your house to your company or start printing tenancy agreements. Instead, you've got two simple options: the simple-to-use flat rate or the proportion of actual costs. And let's have a look at these in more detail. So, option one, the flat rate home working allowance. HMRC lets you claim £6 a week tax-free if you work from home. No receipts, no number crunching, just say, yes, I do business from home, and boom, £26 a month, £312 a year, zero paperwork. Sole trader? Add it to your self-assessment. Limited company? Put it through the accounts and reimburse yourself. It's not going to buy you a yacht, but it'll definitely pay for a few cheeky Pret coffees. Option two, claiming a chunk of actual household costs. Now, if you're working from home more seriously, like multiple days a week or full-time, you can go a step further and claim a fair slice of your real household expenses. And don't forget, if your other half is working in your business and being paid through your payroll, then they're working from home, and this counts for those as well. We're talking about gas and electricity. Those Zoom meetings don't heat themselves. Water, internet and broadband, council tax, home insurance, mortgage interest or a portion of your rent, not the whole thing. Even a portion of your cleaner if the office gets hoovered. And the catch? You can only claim the business use portion. So you'll need to work it out based on things like how many rooms in the house, how many hours you use the space, whether it's a shared room or a dedicated workspace. HMRC loves reasonable apportionment, so don't go claiming your hot tub as a business expense unless you're an underwater podcast producer. Oh, and you can't claim your mortgage capital repayments. You also can't claim your rent in full unless there's a legal rental agreement. That second bedroom either you say is an office but is mostly laundry, and the exercise bike is in there that never gets used. And yeah, this won't make you rich overnight, but whether it's £312 or $800 a year, that's tax-free money you're already spending. And now it's working for your business. And if nothing else, it makes that work from home lifestyle feel slightly more productive, even if you're still in your pajamas. This next one applies whether you're a limited, sole trader or a partnership. Bought a laptop, new office chair, forklift, funky ergonomic mouse that looks like a sci-fi prop from Blade Runner? Well, you can probably deduct the full cost using annual investment allowance, AIA for short. AIA lets you knock 100% of the cost of qualifying items off your taxable profits up to $1 million per year. And this includes things like laptops, desktops, and all things techie, office furniture, tools, machinery and work gear, lighting, aircon, security systems, electric fans and commercial vehicles. Oh, and that standing desk you swore you'd use more. So, how do you claim for this? Well, if you're a limited company, include the purchase in your company accounts. Enter the total eligible spend in the capital allowances section of your CT 600, your corporation tax return. It's then deducted from your taxable profits before calculating corporation tax, resulting in a lower tax bill. If you're a sole trader, enter the capital expense in the capital allowances section of your self-assessment tax return. Deduct it from your self-employed profit. The result? Lower income tax and lower Class 4 national insurance contributions. That's more money for you and less for HMRC's Hobnob Fund. Now, have you paid for business stuff with your personal card? Things like travel, software, tools. What about when you first set up the business? Well, for limited company directors, don't worry, you're not out of pocket for personally paying expenses on behalf of your business. You can reimburse yourself through the director's loan account. That's basically like an IOU between you and your limited company. All you need to do is make a one-time transfer from your business bank account to your personal account, or include it in your next monthly expense reimbursement. And this payment is tax-free for you personally, and it's deductible for the company, reducing your corporation tax. Just think of it as money the company owes you. So when you do finally reimburse yourself, you're just withdrawing your own money that you've previously paid tax on. So there's no income tax on this, no NICs, no dividend paperwork. Everybody wins. Okay, hear me out with this next one. You've got a meeting with a client in Leeds, but you live in Manchester. You choose to buckle up and make the journey in your personal car, partly for your own comfort, partly for the collection of CDs you've got in the glove compartment, partly for the uncanny podcast that you want to listen to. It's a business trip, no question. Now, here's what most business owners don't do. They don't reimburse themselves, or they reimburse only the cost of the fuel, which is a big mistake because HMRC allows you to claim far more through mileage. It's surprising how it works out. If you're using your own car for business travel, HMRC allows your limited company to pay you a fixed tax-free mileage rate. And it's a powerful way to get cash out of the company without paying a penny in tax or NICs. For a car or van, the approved mileage rates a 45p for the first 10,000 miles in the tax year, then 25p per mile for any miles over 10,000. All you need to do is track your business miles using a simple mileage log. You can use apps like MileIQ, TripCatcher, or Driver's Note. Your log should include, though, date of journey, start and end location, total miles, purpose of journey. HMRC expects accurate records. Vague entries like went to see Bill won't cut it. Let's talk about a strategy that sounds almost too simple, but is totally HMRC approved when done correctly. Employing your spouse or family member in your business. They help you, you pay them, and HMRC actually supports it. Whether it's your partner helping with admin, your son filming product videos, or your daughter updating the website. If a family member is genuinely working for the business, then paying them through payroll can unlock huge tax savings for your company and your household. You can pay them up to the $12,570 personal allowance without triggering income tax. If they're not a director and the company is eligible, they also don't pay employee national insurance up to $12,570, and they might help the business qualify for the employment allowance, which as of the 6th of April, it increased to $10,500. And I'd recommend checking out our other video, Step-by-Step Guide to Registering as an Employer in 2025, if you want a more detailed guide on setting up a payroll scheme through your limited company, but it's definitely worthwhile. Let's talk tax and romance, because nothing says I love you like income shifting. If your spouse is sitting on unused personal allowance, lower tax bands, or that sweet little £500 dividend allowance just collecting dust, you can transfer a portion of your company shares to them, legally shifting part of the dividend income into their hands. Translation: you reduce your joint tax bill and keep more of that money in the family biscuit tin. Don't worry, the hobnobs are kept somewhere safer because I like hobnobs. And before you ask, no, I won't stop the hobnob talk, because let's be real, they are the superior biscuit. But getting back to the topic at hand, HMRC aren't exactly lovebirds. They don't mind this setup if you do it by the book. Otherwise, they'll come sniffing around faster than your dog at Sunday race. Here's how to stay squeaky clean. Firstly, your spouse must actually own the shares, not just on paper, not technically. We're talking official, recorded, company's house level ownership. And yes, the dividends must go directly to their account, not yours with a winky emoji. Secondly, avoid the anti-avoidance trap. Hang on, it must be a non-double negative way of saying that. Non-double. No, I'm sticking with that. Anyway, cracking on. HMRC has a rule that basically says, if you give away income but still control it, nice try. So here's what you need to do. The gift of shares must be outright and unconditional. No strings, no takebacks. Your spouse should control the income and the shares. Give them voting rights too. Yes, they'll technically outrant you at board meetings now. Choose wisely. This trick doesn't just save tax, it builds financial teamwork. And hey, what's more romantic than jointly lowering your dividend tax bill? Let's touch on something most business owners forget in a bad year: a trading loss. It's not the end, it's a tax-saving opportunity. If your business made a loss, whether you're a limited company or a sole trader, you may be able to carry the loss back to a previous profitable year and reclaim tax you've already paid. Or carry it forward to reduce tax on future profits. No profits last year? No problem. You can carry that £20,000 forward and offset it against next year's profits, reducing your tax bill when things pick up again. If you're a sole trader, you've got even more flexibility. You can use the loss to offset employment income from the same or previous year, even outside the business. That's what's called sideways loss relief, and it can result in a sizable income tax refund if used properly. The key takeaway: don't just eat the loss, put it to work. Now, if you're testing out a side hustle, maybe you've made a few hundred from coaching, cupcake orders or selling on Etsy. The good news is you don't need to register for self-assessment unless you earn more than £1,000 from it. That's thanks to the trading allowance. Everyone gets £1,000 per tax year of trading income completely tax-free. It applies even if you're already employed or you're getting dividends. Let's say you earn £700 selling prints on Etsy, or you get £950 a year doing freelance proofreading. Well, you don't need to register with HMRC. There's no tax, there's no paperwork. This one's perfect if you're starting small or you've got a bit of a side hustle that it isn't worth setting the full business up just yet. This next one's a classic for limited company directors, but it is more nuanced than people think, especially with changes to national insurance thresholds and dividend tax bans. So here's the updated play for 2025-26. If your company only has you on the payroll, you'll want to pay yourself a small salary of £5,000. That's the level just below the employer's NIC threshold. So no employer NI, no employee NI, but it also means you won't qualify for state pension credits. If you do want to have more state pension credits, so you still got more years to do, then you want to pay yourself £6,500 per year. That then is the most that you can take and still qualify for those pension credits, but you will have a little bit of employer NI to pay. Just be aware of that. Take the rest then as dividends, and dividends are taxed at 0 up to your £12,500 personal allowance, 8.75% in the basic rate band, but be aware they're taxed at 33.75% above 50,270 in the higher rate tax bracket. So this is when really it needs checking again, as taking all your income as salary could actually now be more beneficial for you. You might have to pay 40% tax and NI on top of that. However, you're saving corporation tax of 20 to 25%. It's always worth running the sums. And don't forget that tax-free $500 dividend allowance. If your company has other employees and qualifies for the employment allowance, you can raise your salary all the way up to the full person allowance, £12,570 or £1,047.50 per month, and you still avoid then employer NICs. You'll reduce your corporation tax bill and still keep your personal tax low. It's all about structuring the mix correctly based on your company setup and your personal circumstances. Ever wish you could pay different dividend amounts to different shareholders? Well, that's where Alphabet shares come in. Instead of everybody holding the same class of share and receiving dividends proportionately, which is what you have to do if you all own the same share class, you can issue different share classes like A shares for you, B shares for your spouse, C shares for your children or future investor. That gives you the flexibility to pay £10,000 in dividends to one person, £2,000 to another, and just the £500 dividend allowance to another without needing to change the ownership structure. It's especially useful when one shareholder is in a lower tax band, or someone isn't involved in the business anymore, or you want to incentivize someone with performance-linked dividends. To do this, you'll need to update your articles of association, issue the different classes of shares, record everything properly in Companies House and your share register. Get your accountant or company secretary involved to set it up properly. But once it's done, it gives you full control over how profits are shared. Oh, this one's a hidden gem for limited company directors. You can treat yourself or your employees to small gifts completely tax-free under HMRC's trivial benefits rules. What's allowed? Well, it's maximum of £50 per benefit. It can't be cash or a cash voucher. It can't be given in exchange for work done, and it mustn't be written into their or your employment contract. As a director of a closed company, that just means your own, you can receive up to £300 a year in trivial benefits. Think your local supermarket shopping vouchers, for example, Amazon vouchers. There's so much to choose from. That's 6 gifts of £50 a year, tax-free and NIC-free. So whether it's a fancy bottle of wine, a nice dinner out, an Amazon gift card, or the fuzzy slippers you've been eyeing up for when you work from home, you can get it through the company, deduct it, and avoid tax entirely. Just keep it under £50, don't tie it to performance, and don't go over your annual cap. Here's a rare treat, a tax perk that literally lets you throw a party and write it off as a business expense. No, really, HMRC actually allows it, as long as you follow a few simple rules. Your company can spend up to $150 per head per year on annual events. And the best part, it's a deductible business expense. It's tax-free for your team, even if that team is just you and your dog named Kevin. And it's morale boosting, which counts as strategic HR in your next board meeting with yourself. The rules, also known as how not to get your tax-free bubbly taxed. The event must be open to all employees, not just your favourite one. The cost must not exceed $150 per person. Go over by a single pound and HMRC will tax the entire thing. Think Cinderella, but with spreadsheets. You can throw one big bash or multiple smaller events, again, as long as the total stays under that $150 per head cap. Even a one-person company qualifies. So, if it's just you, book the fancy tasting menu, raise a glass to ongoing stakeholder engagement, and enjoy your tax-free treat. If you're finding this video helpful, subscribe below. We put out weekly videos offering tax-free advice. They're no fluff guides. If at any point you find that it's not been as useful as you thought, click unsubscribe. No harm done. Now, did you know that your company can provide one mobile phone per employee, including for you, the director, and it's completely tax-free? That means the phone itself, the monthly contract, and even accessories if bundled. Just make sure the contract is in the company's name, it's provided for work purposes, and occasional personal use is fine. For example, your company signs a 24-month contract at £50 per month, so that's $1,200 in total. That's a full deduction for the company and zero tax or NI for you. Perfect for anyone who uses WhatsApp, Gmail, Zoom, or any other apps for business and you don't want to pay for it personally. If you've got little ones and ever looked at your childcare bill and wept into your coffee, good news. The tax-free childcare scheme is basically the government saying, here's a bit of help, please don't ask us for any more. It's wildly underused, yet ridiculously useful. Here's the deal. For every £8 you pay in, the government chips in £2. So that's up to $2,000 a year per child, or $4,000 if your child is disabled. You must use a registered childcare provider, so your neighbour's 14-year-old probably doesn't count. Sorry, Chloe. Also, how to snag it. Set up a tax-free childcare account at gov.uk. Yes, I know, another government login. You know the drill. Link it to your childcare provider. Pay through that account to get the juicy top-up, and this way, every £8 becomes £10. It's like a loyalty scheme, but instead of free coffee, you get help surviving half-term. But wait, high earners, watch out. If either parent earns over $100,000 in adjusted net income, you lose the perk. Brutal, we know. So, if you're floating near that threshold, maybe hold off on that big dividend or freelance side gig until you've sorted the childcare bill. And a pro tip, use this before you even think about shouting at HMRC. It's one of the few times they'll actually give you something back. Do you want a new bike and accessories tax-free? The Cycle to Work scheme allows you to buy a bike through your limited company and lease it to yourself via salary sacrifice. And the benefits are you don't pay tax or NIC on the value. The company gets full tax relief, and you can include accessories like helmets, lights, locks, even panniers. Now, let's say you buy a £1,000 bike. After tax savings, it might cost you $600-700. You lease it monthly via the payroll, and buy it at the end for a nominal value. Healthier, greener, and financially smarter. What's not to love other than the dull ache in your calves and butt for the first couple of months? Now, I know we mentioned using your director's loan account earlier as a way to take money tax-free from the business, but what if you've got a bit of extra income on top by charging interest on the money the business owes you? Here's what most directors don't realise. You can legally charge your company interest on that loan, and it's a tax-efficient way to extract money from your business because the interest on repayments are a tax-deductible expense for the business. You'll need to draft a loan agreement to set it up properly, and I'd recommend including the following: the loan amount, so the interest rate on that, and it must be commercial, typically 3 to 8%, repayment terms for it, the payment frequency, and this is a great strategy for funding your business without dipping into overdrafts or expensive credit and getting paid for doing so. Just keep in mind the interest you receive from your company is seen as personal income for you, so much like all other income, it must be declared with HMRC. However, you have a tax-free interest allowance personally. Moving on, if you or a new employee have to move on for business reasons, see what I did there? Your company can pay up to $8,000 in relocation expenses completely tax-free. Now, that includes removal costs, estate agent, legal fees, temporary accommodation, sometimes even stamp duty. To qualify, the move must be necessary for the job, so you can't just move to Tenerife without it being absolutely mandatory. The new home must be significantly closer to the workplace, so definitely not Tenerife then. The cost must be incurred within 12 months of the move. It's often missed, but it's extremely valuable if you're scaling your business or you're hiring from out of town. Your business can cover the cost of any HMRC approved professional memberships, completely tax-free and fully deductible. That means memberships like ICAEW for the number crunching accountants, CIPD for the people whispering HR praise, the Law Society, FSB, marketing groups, trade bodies. Basically, if it makes you look serious, it probably counts. For example, say you run a design consultancy and you pay £250 a year to the Chartered Society of Designers. Paid through your company, £250 off your tax bill and zero tax on you. No hidden fees, no secret handshake required. Just remember, it has to be wholly and exclusively for the business. So, one that I like, if you join in the Royal Society of Cake Tasters, that might be a harder sell to HMRC. Check HMRC's official list if you're not sure, because cake is delicious, but it's not always deductible, sadly. Now, let's talk about something everyone can take advantage of, even people just working a PAYE salary. Salary sacrifice is where you swap part of your gross salary in exchange for a tax-efficient benefit like pension contribution, cycle to work scheme, childcare vouchers, legacy only, low emission company car, private health insurance if structured right. And why it works, your salary, your taxable salary is lower. You pay less income tax and NIC. The company pays less employer NIC too, so it's good for them. Just be aware it can impact mortgage applications and statutory benefits, so plan accordingly for that. But what if you're winding down your company or planning a retirement or exit? Well, you can pay yourself a termination payment of up to $30,000 tax-free. The payment must be compensation for loss of office and not related to work already done. It mustn't be part of a contractual obligation, and it's often used as a final extraction strategy before closing a company or stepping down. It's often combined with business asset disposal relief, and I'll get to this, don't worry. Make sure it's documented correctly on your final pay slip and closure paperwork. That's very important. As I promised, here's more on BADR, B-A-D-R, previously called Entrepreneurs Relief, now Business Asset Disposal Relief. This allows you to sell your business or shares and pay just 14% capital gains tax instead of 18% or 24%. And the rules? Well, you must own at least 5% of the business, you have to be an employee or director, and you have to have held the shares for at least 2 years. You get a £1 million lifetime limit, meaning up to £100,000 in tax savings. If your spouse is also a shareholder and meets the same criteria, then you both get the allowance. That's £2 million at 14% CGT. Brilliant saving. This next one's about timing. If you're earning close to a higher tax band or you're expecting a dip in income next year, you can delay taking dividends or salary until the next tax year. So, for example, you're currently earning $55,000. Any extra dividends you take are taxed at 33.75%. But next year you expect that to drop to $25,000. Well, if you delay that $20,000 dividend until next year, you're only going to pay 8.75% tax, saving you £5,000. Just make sure the dividend paperwork, the board minutes, the vouchers, etc., is dated after the 6th of April. And then you consider cash flow and other income like child benefit clawback. Let's talk about something everybody needs but nobody wants to think about. Life insurance. Yep, we'll go in there, but briefly. Here's the good news. Your limited company can pay for a relevant life policy, a tax-efficient life insurance policy designed for directors and employees. And it comes with some serious perks. It doesn't count as a benefit in kind, so there's no extra tax for you personally. It's a fully deductible business expense, lowering your corporation tax. The payout to your family is also tax-free. No inheritance tax, no stress. Premiums are paid by the company, not from your personal income, so the payout won't mess with your pension lifetime allowance. Basically, it's like regular life insurance, but with a cape. It protects your family, saves your company tax, and HMRC doesn't even side-eye you for it. Perfect if you want peace of mind without paying for it of your already taxed pocket. Because if there's one thing more depressing than dying, it's dying and knowing HMRC got one last slice. But sometimes the best way to reduce tax is not to extract the money at all. If you reinvest your profits back into the business, you avoid triggering personal tax, you grow your long-term profitability, and you increase the company's value, especially if you plan to sell one day. You can reinvest in things like staff, equipment, marketing, training, new products or services. You then avoid paying corporation tax and personal tax on profits that are going to work for you again. And there you have it, 25 tax-saving strategies, all legal, all HMRC compliant, and all designed to help you keep more of what you earn. Some are quick wins, others need a bit of setup, but together they can completely transform the way you take money from your business. See you next time.